Welcome to the new lecture series of Cost and Management Accounting. In this video, I'm going to cover the definitions of management accounting, nature of management accounting information, objectives of management accounting, scope of management accounting, as well as functions of management accounting. Other than that, I'm going to compare the financial and management accounting as well as how it impacts on levels of planning and control. Now let's look at what is accounting. Accounting is the process of identifying, measuring, recording, classifying and summarizing and communicating economic information to permit informed judgments and decisions by the users of the information. So you know that accounting can be divided mainly into two categories: financial accounting as well as management accounting. Management accounting is a discipline concerned with the preparation of financial and related information used by managers inside the organization to make strategic, organizational, and operational decisions. Actually, management accounting is not only about accounting. It combines finance and management with innovative techniques that require to drive a successful business. According to CIMA, the Chartered Institute of Management, the application of the principle of accounting and financial management to create, protect, preserve, and increase value for stakeholders is known as the management accounting. Now let's look at the nature of management accounting information. We all know that it's provide accounting information for forming policies, as well as it is future oriented. It enables managers in the forecasting of future events by providing all relevant information that is used for analysis purpose. It studies the causes and effects of various facts as well as figures. There is no fixed norms to be followed. Management accounting tools may be different from one organization to the other organization. Using of different tools of management accounting is fully dependent on the person who are using it. Therefore, general accepted accounting principles may not be applicable here. It supplies information but not the decisions. Management accountants supply accounting facts and information, and also they provide interpretation. But the decision making is fully dependent on higher authorities. They are using techniques of selective nature, depend on the business organization. Sometimes they may apply process costing. Sometimes they may use ABC costing. Sometimes they may use job costing, as well as they may use different tools such as budgetary control, ratio analysis, responsibility accounting, so far and so forth. So these techniques may create the accounting data more useful and helpful. The fundamental objective of management accounting is to enable the management to maximize profit or minimize losses. Other than the fundamental objective, there are some other objectives of management accounting. It used for planning and policy formulation. Management accounting facilitates the preparation of financial statements in the light of past result and gives estimation for the future. It's used for interpretation process. Normally, management accounting is to present financial information to the management in such a way that it is easily understood. With the help of statistical devices like charts, diagrams, graphs, they can make this is an easy task for the non-accounting managers. It assists in the decision-making process. With the help of various modern techniques of management accounting, it makes the decision-making process more scientific. Data related to the cost, price, profit, and saving for each of the available alternatives are collected and analyzed and provide a base for taking sound decisions. Management accounting is used as a controlling tool. It helps for managerial control. Tools like standard costing, budgetary control are helpful in controlling performance. Cost control is effect through the use of standard costing and departmental control. So performance of each and every individual is controlled with the help of management accounting. It facilitates the reporting. Management accounting keeps the management fully informed about the latest position of the concern through reporting. It helps management to take proper and quick decisions. The performance of various departments is regularly reported to the top management, so they can fasten and make corrective decisions. It facilitates organizing. So return on capital employees is one of the tools of management accounting. Management accounting stress more on responsibility centers with the few control of cost and responsibilities. It also facilitates decentralization to the greater extent. Thus, it helps in setting up effective and efficiently organization framework. The scope of the management accounting is very broad. It covers a wider range. Therefore, it is very difficult to pinpoint the exact scope of management accounting. However, I have narrowed down the scope of management accounting and listed below. Management accounting scope covers the financial accounting, cost accounting, budgeting and forecasting, cost control procedures, financial management, financial statement analysis, interpretation of data, as well as reporting. Now let's look at the functions of management accounting. It allocates the cost between the cost of goods sold and inventories for internal and external profit reporting. Further, it provides relevant information to help managers to make better decisions. This involves both routine and non-routine reporting. Finally, it provides information for planning, controlling, and performance management. Now let's see what are the differences between financial accounting and management accounting. Financial accounting provides information to the external parties who are outside the organization, whereas management accounting provides information to the internal parties for planning, directing and motivating, controlling, performance evaluation. When we focus on the legal requirement, financial accounting, there's a statutory requirement for public companies to produce annual financial accounts based on the CSE requirement. When it comes to management accounting, there is no legal requirement. It is optional. You can prepare whenever you want. When it comes to segmenting, financial accounting primarily focuses on the whole organization. However, management accountant can prepare management accounting for different segments of the organization. When it comes to time focus, financial accounting is historical perspective. It is emphasized financial consequences of the past activities. However, management accounting is future emphasis. It's always focused on the future. There is must to follow general accepted accounting principle in financial accounting. However, there is no requirement to follow gaps in management accounting. Financial accounting reports must be published annually if you are in the main board. However, if you are listed in the Dirisavi board, less detailed annual accounts can be published in semi-annual basis. But the management accounting reports should be produced more frequently because day-to-day decisions are taken based on these information by the management. Managers everywhere carry out three major activities, that is planning, directing and motivating and controlling. So for each activities they need the managerial accounting or management accounting information. For planning involves a basic strategy and selecting a course of action and specifying how the actions will be implemented. In directing and motivating involves mobilizing people to carry out plans and run routine operations. When it comes to controlling, it involves ensuring the plans is actually carried out and is appropriately modified based on the circumstances. So management accounting informations play a vital role in these basic management activities, but more particularly in planning and control functions. Let's look at the levels of planning and control. Here we are focusing on the organizational planning and execution levels. You know there are three levels in an organization: strategic level, tactical level, as well as operational level. These levels are making different types of decisions. Strategic level is making strategic decisions such as pricing, business or market development, new product development, and mergers and acquisitions. For these decisions, they are going to use benchmarking, customer profitability analysis, and investment appraisal techniques. For tactical levels, they are going to make tactical decisions such as credit terms, stock levels, wage rates, and number of workers for production, etc. For those decisions, they are using incremental analysis, EOQ models and stock models, CVP analysis. Finally, in the operational level, they are going to make operational decisions. Decision to increase company's operational efficiency, including logistic decisions, employee management, as well as customer management. For these decisions, they can use TQM, Kaizen costing, customer relationship management, throughput accounting, as well as variance analysis. Most of the organization's main objective is to earn profit or minimize cost. A business must plan for success. Planning must be occur at all levels. Planning can be used for strategy making, positioning, as well as budgeting. Strategy is a plan of action designed to achieve a long-term goal. It can be divided into core values, that are the fundamental beliefs and principles that drives the organization. It's applicable to every person within your organization. It can be fair pay, human dignity, ethics, employment promotions or compensation or quality, customer service, and environmental awareness, and so forth. Then we are going for the mission. Mission statement provides a snapshot of the organization. It describes the organization purpose and its overall intention. Finally, the objectives. Business objectives are something which a business organization want to achieve or accomplish over a specific period of time. Positioning defines where your products stand in relation to others. For that, we can use CVP analysis and scalability. It is important for managers to understand the nature of the cost behavior and how it changes in volume impact profitability. You have to learn about how to calculate break-even points and how to manage to achieve the target income levels. Further, it involves global trade and transfers, international laws about traffic, taxes, shipping has to be learned in order to measure the reasonable transfer prices. Finally, branding, pricing, sensitivity and competition. Product pricing decisions must be balanced against cost and competitive market conditions. Therefore, we have to use the sensitivity analysis to determine how sales and cost will be responded based on the market conditions. Now let's look at budgeting. A budget is a financial planning showing how resources are to be acquired and used over a specific time interval. Management accounting helps determining the budget forecast for the coming period. This budget planning can be done at different levels of the company. Budgets can be planned for each project, department, product, location, marketing campaign, or any other planned action by the company. Operational budget is a detailed projection of what the company expects its revenue and expenses will be over a period of time. When it comes to capital budgeting, it is a method of estimating financial viability of a capital investment over the life of the investment. Finally, we can use financial budgets. Financial budgeting is the process of planning company expenses and revenue for a time period. Now let's see how management accounting information, tools and techniques help for planning in organization in different stages at different levels. In a summary, management accounting support the directing function in many ways. Area of support include costing, production management, and special analysis. Costing is used to calculate the cost of goods or services. They can use different methods which applies to different production and decision environments, such as activity-based costing, job costing, as well as process costing. At the same time, they can use different concepts, such as absorption costing. This is the costing which used to calculate the full cost of production. Absorption costing is required for external reporting purposes under general accepted accounting principles. When it comes to direct costing, this is used for short-term decision making. Not only the costing, but also the production management is really important in the manufacturing organization. In a manufacturing organization, more than 80% of the cost is represented by the inventories. When it comes to inventory management, management accountants can use different methods such as JIT, MRP, as well as EOQ. Not only the inventory, but also the quality is really important. For quality management, there are several components they have to be in touch. That is quality planning, quality control, quality assurance, as well as the quality improvement. Sometimes management accountants has to make special analysis in order to decide whether we are going to make it is in factory or whether we are going to buy it from the outside, or when there are limiting factors to select the best product to maximize our contribution, or finally the profit, or sometimes whether it's viable to make inside or whether it's viable to outsource. In the control function, managers seek to ensure that the plan is being followed. Controlling can include monitoring, certification and reliability, as well as balance scorecard. Monitoring can be done by using standard costing and variance analysis to check whether the actuals are in line with the plan. Then, certification and reliability can be done in many ways by obtaining international standards as well as in line with the local standards. When it comes to quality management, most of the organizations use ISO 9001. When it comes to environment management standards, they are using ISO 14001. That is a framework that a company or organization can follow to set up an effective environmental management system. When it comes to locally, Sri Lanka, we have SLAs. So you can check whether your production is in line with the Sri Lankan standards. Then we have the balance scorecard. Balance scorecard is a strategic performance management system that is used by managers to keep a track of the execution of the activities by the staff within their control and to monitor the consequences arising from these actions. It will provide the feedback on both internal business processes as well as external outcomes for continuous improvement. Management accounting control system is an administrative device that organizations use to control their managers and employees. It is used for planning, monitoring, and control of various organizational activities to optimize the use of resources, to support the decision-making process, and to evaluate performance. Management accounting control system have two core elements. The first is the formal planning process, such as budgeting and long-term planning. These processes are used to establishing performance expectations for evaluating performance. The second is the responsibility accounting. This involves a creation of responsibility centers. So if you stayed with us till the end of this video, you may have gained an understanding with regard to the management accounting, objectives, scope, as well as functions, and the nature of management accounting information, and you may understand the differences between financial as well as management accounting. I have explained the levels of planning and how management accountant can use management accounting information for controlling purposes. Stay tuned. In my next video, I will go in depth with the management accounting, cost and cost behavior.